Welcome back. And in our top business story, the volume of non-oil foreign trade for Abu Dhabi in terms of value stood at 139.4 billion dirhams in 2011, up by 27.7% compared with 109.2 billion dirhams for the same period in 2010. The results, according to the statistical report issued by the section of statistics at the Directorate of Customs in Abu Dhabi, showed that non-oil Abu Dhabi exports during the last year touched 11.5 billion dirhams, dropping by 1%. The report also showed that the volume of imports surged to 116.4 billion dirhams in 2011 compared to 86.6 billion dirhams in 2010, up by 34.4%. Meanwhile, the volume of re-exportation trade reached 116.6 billion dirhams, up by 5.3%. Most imports came from the US, with a total of 13.4 billion dirhams, followed by Saudi Arabia, South Korea, Japan, Germany, Italy, France, the UK, China and Australia respectively, at a total of 81.5 billion dirhams. Meanwhile, Canada, Saudi Arabia, Brazil, Oman, Qatar, India, China, Egypt, Kuwait and Iran were top regarding non-oil exports at 9.8 billion dirhams. The UAE Central Bank announced today that total bank deposits in the country rose by 1.5% during the December 2011 to close at 1.06 trillion dirhams. Meanwhile, total bank loans and advances decreased by 0.3% to reach 1.07 trillion dirhams, and total bank assets fell by 0.6% to reach 1.66 trillion dirhams at the end of December 2011. Money supply, currency in circulation plus currency at banks decreased by 2.1% from 53.2 billion dirhams at the end of November to 52.1 billion dirhams at the end of December last year. Telecom operator Du has proposed its first dividend payment to its shareholders after making a net profit of 1.1 billion dirhams last year, up 10% from 1 billion in 2010. This comes after a loyalty fee to the UAE federal government of 715 million dirhams compared to last year's 184 million dirham loyalty fee. Du is looking at a dividend of 0.15 dirhams per share, a fee of 15% net profit and 5% of total revenues for the first time. According to a statement, Du chairman Ahmed bin Biat stated that the decision to pay dividends celebrates the position they have built in the market, and that today more than 5 million people across the Emirates actively use Du services. And with that, let's now look at the stock indices across the GCC. Chinese Premier Wen Jiabao cut his nation's growth target to 7.5% for 2012 on Monday to give the economy more room to slow down if needed, while the government carries out promised economic and welfare reforms. So what areas of the Chinese economy is this rebalancing most likely to affect, and what about other global economies? Well, we spoke with Tim Fox, the chief economist at Emirates MBD.
Well, the Chinese economy has been growing at very fast pace in recent years, in excess of 9% in most of those. But there has become an imbalance in the economy. Particularly the real estate sector has probably grown most excessively, and I think there is an attempt at the moment to try to slow down the growth of that sector, and the rapid appreciation in certain real estate assets, which has the potential to cause problems down the road. Now, a 7.5% growth rate is a forecast for 2012. I think it's unlikely that growth will fall as weak as that. Will be as weak as that. 2011 saw growth of 9.2%. Most likely, you'll see a growth slowing down to around 8.5%, I think, this year. The forecast also is consistent with the 5-year plan presented towards the end of last year, which pegged 7% growth as a prospect over coming years. So I don't think these forecasts necessarily change an awful lot. It recognizes what most, I think, analysts assume anyway. Growth is likely to remain strong compared to other parts of the world, the developed world in particular. And again, this forecast doesn't deviate from that.